stocks, bonds, ETFs, straight out of downtown Chicago. This is Zach's Market Edge.
Welcome to Zach's Market Edge, the podcast about investing in your life. I'm your host, Tracy Reinick, and this week I'm joined by Zach's senior stock strategist and the editor of the Taser and Healthcare Innovator Portfolios, Kevin Cook, to discuss the growth stocks and what's going on with them. Is the growth stock rally over? Is this just a dip? Should we be buying the dip? What is happening out there with the growth stocks? Kevin, they've been our bread and butter for years now, but especially over the last year. And it feels kind of painful right now.
So should we clarify what we mean by growth stocks? Do we mean, how many different areas of technology, and is it just technology?
No, I think it includes like some of the healthcare, some of the biotechs and drugs, medical products. A lot of those are big growth names. And
what about retail, restoration hardware?
I would put some of those into the growth category.
Or LULU?
Definitely.
Is LULU still a growth stock?
For sure. Those real hot retail names like the LULUs and RH for sure. Let me think who else. Maybe
if I was going to put a metric on it, I would say that the reason we call them growth stocks is because they do tend to have revenue growth over 20%.
Yeah,
which is great. What every investor loves, and until that flattens out, what happens is investors pay higher multiples for those stocks. They'll pay 10, 20, even 30 times sales for something that can grow sales at 20, 30, 40%.
Right. And that is what those, at least LULU for sure, investors are willing to pay the higher valuation to get that one. RH isn't as expensive as you might think, even though it is growing its revenue in the double digits. So it would qualify as the growth, but it's not.
Yeah, I see 32% revenue growth this fiscal year.
Yeah.
And it drops off next year, but sometimes analysts just haven't updated their model for next year.
Correct. And they are about to report earnings, both of those companies actually. So they'll be updated once they report again here. But some of the big names that everybody has just been buying and loving, like fintech names, those have just been getting hammered, like PayPal, for instance. I know it's been talked about endlessly the last couple of weeks, but it's now down 34% in just the last 3 months. And I looked up what the valuations were doing on that one. So it is cheaper than it used to be with this pullback. So, but price to sales is 9 times. That's not as bad because it was as high as 16 times this year on the price to sales for PayPal. Yeah. So, that one's getting hammered pretty good. But I'm
a big Square fan, as you know. And so I'm perplexed at both Square and PayPal falling off the map here. It almost makes me wonder, is there something I'm missing that's going to happen either regulation-wise or cryptocurrency-wise or something that's going to hurt the Square and PayPal business models, even though they're dominators in fintech? It just makes me wonder if I'm missing something that, that somebody else sees.
I don't know. I've been trying to figure it out, but a lot of people have big gains in a lot of these stocks. So I feel like a lot of them, if they're new investors, are just kind of like, hey, I'm cashing in and I'm going to go move to the sidelines.
Yeah. When you get these, successive downtrends, that just persistent sell-offs, it tends to keep forcing out new layers of old longs, So anybody who has long-term gains in PayPal from under $100 is getting forced out now because they're like, oh my gosh, I didn't think it would go down this far. I better grab them while I can.
Right. We're seeing that with a lot of names. But what about like some of the healthcare names like Exact Sciences? You and I have both owned that one in various portfolios.
Yeah.
And I own it in my own personal portfolio. I just had to sell it out of my value investor. It's down 35% year to date here now. And it's seemingly it's kind of found some support here above $80, but it's just been down for Exact Sciences.
Yeah, if there was, if there were some doubts about, how quickly they would monetize, new segment growth areas.
Yeah.
And so, yeah, they just basically it's a re-rating of the valuation.
Right.
They're looking out like, hey, it'll take us a couple more quarters before we see how these new business areas and R&D are going to work out.
What about some of the names that are like more recent IPOs or kind of like the meme type of stocks? Like I'm thinking DraftKings in particular. DKNG is the ticker with that one. Year to date now, the shares are down 27%. They are still don't have any earnings, but this was a popular one kind of out the gate, and it's just down, seemingly every day now.
Yeah, I mean, if they're going to take big software like PayPal and Square to the woodshed, anything related to software and e-commerce, we've talked about Pinterest. Let me look at Shopify and see if that's still holding up, because Shopify made the breakout to 1,700. It's still holding above 1,500. Shopify probably looks the toughest of anything.
Yeah, I looked at that one as well, because I was thinking, okay, if Shopify is still holding up, then we might not be done with the sell-off yet. Because I do feel like some of these big names have to kind of at least do a 5% pullback to actually have the selling be done.
Yeah, and what I think Shopify has going for it is it did a big long sideways action for a while. So
it's
now
still
it's
trading
above
with price to sales at 47.
Right. Because it's the next Amazon,
Right.
Yeah. One way for people to easily track software that I like to look at, there's two ETFs that give you sort of the barometer for software, and most people don't know what they are. Like everybody knows the SOX for semiconductors, but for software, you want to look at the IGV, and IGV is cap weighted. So PayPal and Salesforce and Adobe and Microsoft, are going to show up big in the IGV. That's still holding up pretty good. Where you see the pain is in the EXSW, which is the equal weighted software. And that made highs of like about $187, now trading $165, and it's back to levels that we haven't seen since since the summer. So it could find support here where it did in July. That basket of the equal weighted software, which is where you're seeing a lot of the big pain. Like I owned a little Shopify, Big Commerce, BIGC, and they are just destroying that stock. We had a great earnings report. It got all kinds of upgrades, and it got off the ground from 40, shot back up to 64, and now it's trading 43 again. And looks like it's getting ready to make new lows. So there's just no mercy out there for any of the software valuations that got too extreme. There were a lot of things trading 20 or 30 times sales, and all that is just getting compressed.
So is one of the biggest holdings in the IGV Microsoft then? Is that why that's
I believe so. I believe Microsoft is and Salesforce are two of the biggest holdings.
Okay, because Microsoft is down only 0.3% over the last month. Yeah. So it basically, is an area of safe haven right now, at least so far.
Yeah, I'm looking up. This is iShares, the IGV. So I'm going to look it up, and I can just tell you the weightings.
Okay.
Microsoft is probably the big dog here.
So
Salesforce and Microsoft are tied at like 9.5%, and then it's Adobe, Intuit, Oracle, ServiceNow, Autodesk. So the big guys.
A lot of those are still holding up. We're going to get the earnings from Salesforce here. This week, so that should be an interesting one.
Tag that ticker in the show notes.
Yeah. And what are you thinking about some of the other FANG names that aren't overpriced? Some like Facebook or Metaverse as it's now known, but still going by FB. And it's trading with a PEG ratio of almost 1 now.
Well, this is a conversation you and I have been having for, at least 4 years. Are the FANG stocks fads or are they real growth machines? And the fact of the matter is, because of their dominance of scale, they are growth machines. And, they're just, they have huge cash piles. They can borrow cheap and they can move into new areas and generate new business ideas. They don't have to go out and spend $20 billion to buy another company when they can put $2 billion into R&D and come up with something completely new. Those are the fundamentals. What keeps the stocks where they are is that large investors realize that they if they have to have ballast in their portfolio, it's going to be large cap tech growth.
So what's your advice for investors here? This is the first big sell-off for a lot of people. So they're confused, they're emotional. Some might be scared a little bit here, especially if they own something like PayPal, which just keeps going down and they've not seen anything like this. Should they be buying here, or should they try to dollar cost average? Can they try to time it?
Yeah.
Should they wait for some bigger capitulation? I don't know what that would be, but.
So you mean new investors who have joined us in the big game since after the Corona crash?
Yes.
The Corona crash was pretty brutal.
That was brutal. Yes. But a lot of people got in after that, and they've been riding this big wave up. The recovery, the reopen trades, that's all been fun. Heck, even buying, the airlines, that was fun for a while.
So anybody who got in and then watched the software stocks take off in 2020, just all of a sudden you realize that we were going to have 10 years of digitization in 10 months. The digital revolution made software just fly in 2020, and then it just kept going. So then people start to drink the Kool-Aid that, it's always okay for software to trade at 30 times sales.
Right.
And I won't mention the person, but I saw you had you were debating somebody on Twitter who is a software investor, and people are out there trying to justify how you need to buy this dip. And I would say, you could buy a basket of software stocks or you could buy the triple Qs. But the best thing is to get to know a company and buy the company because you believe in its market potential. Now, I did that with Big Commerce, and I still believe, and I actually might buy more Big Commerce down here, just because I think next to Shopify, they're the little guy getting the most traction in e-commerce. And they actually have a partnership with PayPal. Who knows? Maybe that's what's hurting Big Commerce, is that they got a partnership with PayPal. But so I think it's always a great time to get to know companies and get to know business models. For instance, I did top stock picks yesterday on Monday morning that we always do. We rotate that duty. And I picked a company called New Relic. New Relic is software analytics. And they had a blowout report in early November that launched the stock 38% in one day. And I'm going to see where it is now and I think it's going to hold up.
What's the ticker for New Relic?
NEWR, NEWR.
How small is small?
How small is the company?
Yeah.
It's a mid cap. So it's I want to say 7 billion. Yeah, it's a 7 billion market cap.
Okay, so we're not talking about some, like $700 million.
Now, this was a stock I tried to own before the Corona crash, and then I got flushed out just because they hated all these software analytics companies. But this one's in a unique niche. It's in APM, which is Application Performance Management. And what these companies do is they monitor your SaaS, your cloud, your apps, and tell you when stuff's breaking down or if there's bugs or if there's an outage. And they're almost like first responders for your stuff going down, because if your stuff goes, if your communications or software goes down, then that hurts your customers, and you want your downtime as little as possible. So New Relic and PagerDuty is another one in this space. But specifically about New Relic, so the stock pops 38% one day, and it's holding above this 110 level, which was old resistance. And I think it's a buy here. And like some of the analysts just fell all over themselves. Like the guy from JP Morgan, Audie, he did a double upgrade from underweight to overweight. He just skipped neutral altogether. He's like, this company is now executing properly. And so what I want to bring up about business models with software and SaaS is that when I did this profile of New Relic, and you can watch the video on Zacks, I went to their homepage and I noticed they had a really unique selling proposition. They said free forever, no credit card required. And how is that possible? Well, what they're doing is they're offering it to one person at your company, free forever to that one person, with a limited amount of data. And what that does, it's like the perfect test drive, right? Yeah. So that person gets to go in and use it and see, does it work? Does it work for us? And then they get to sell you more seat licenses and more data usage. Right. And the model seems to be working for them.
Wow. Okay. Well, I'll be checking in on that one. But it hasn't pulled back, or has that one pulled back too?
Oh no, I mean, like I said, it was a rocket after its earnings on November 8th. Yeah. And it's only pulled back a little bit. Like it soared 38% from 90, basically around 90 up to, let's say, 125-ish. Okay. And it's only pulled back to 110. Oh, okay. And today, and I told people yesterday, I said, I think this thing's going to hold 110. It's not going to fill that gap because they have re-rated the stock higher. So while we're talking about everything else in software getting re-rated lower, like Square and PayPal and BigCommerce, and Pinterest and whatever else we can think of, New Relic is the exception now.
Well, that's because it was more of a hidden gem and wasn't bid up like a lot of the others. And then it did have an even better than expected quarter. So
yeah, and it's only growing sales around 16-17%, but it trades at under 8 times sales. So it's not a super high flyer.
So your advice would be for some of these ones we're still waiting for them to crack. So let's look at like Pinterest. You just mentioned it.
Yeah. So just to clarify, you asked me about like what my advice was. So I gave a specific example of getting to know a company. That's my biggest advice, because these companies are exciting, and they can be exciting, but they can also be interesting. And unless you know what a company does, and like Tracy, I should always remind people, every company you own, you're on the conference calls. So not only do you understand the fundamentals, you're listening to management. And I think that's so important. That's what people need to do now, is they need to take interest in a company, study it, and get on the conference calls and learn as much as you can about it, so that when there is a sell-off, maybe you see the value that others don't.
Right. So Pinterest was around $80 and now it's at $40. So
remind me.
Yeah, I know. So split in two. But following your philosophy of getting to know the company, if you did know Pinterest, you wouldn't be panicking on that 50%. Because hopefully you're holding it for the longer term. Right. And because you know the rest of the fundamentals and what's going on at the company, that this is basically the shares going on sale here, falling this much. So
I thought so. You know what? And you were a Pins investor. You bought it for under $20, I think, for your value investor. And I missed that trade. But so I've learned a lot about the company from you, about how they've evolved. Yeah, they had a great 2020 during the stay-at-home shutdown, and then somehow investors think that's all over with. But they actually are doing a lot of cool things. They're doing stuff with, they're expanding into e-commerce. They're using video. They got the video guru from YouTube is now working for them for content creation. So I just saw it as sort of another mini e-commerce platform / social media that could compete on some level with a Facebook or a Shopify.
Right, for sure. But, it could we could still see some more weakness here before it bottoms out. I don't know, but we'll see. But again, all this is buying opportunities for some of these names where you know what's going on behind the scenes and you know that it has good fundamentals.
Yeah, you can't just take somebody else's word for it. You really do have to do your own homework so that you believe in it.
Yeah, I think that's key too. I think a lot of people just buy, whatever the hot names are, but what's being mentioned on Robinhood or whatnot without really knowing much about the company or even really why they're buying it.
What about Peloton? We've talked about that before, and I keep hearing good things about the growth story and their captivation of their customers, and that it might be cheap here. That looks a lot like pins from 170 to 43.
Yeah, I'm kind of mixed on that one because I'm not sure how many people are going to keep buying the bike. I don't know, but they also have the subscription where you can, get all the content too, which has been a big driver for them. But as the shares get cheaper, it could be an interesting play. I'm not sure what I think about that.
I think I've mentioned before that our buddy Howard Lindzen, the founder of StockTwits, is a big fan. He's a guy who bikes on the road, and he also loves everything about the Peloton ecosystem at home. And it's trading for. God, is this right? Is it trading for 2x sales? I see $6 billion projected revenue next year, and the market cap is $13 billion. So a little over 2x sales on a forward basis. I mean, that's pretty cheap if they really are building a software ecosystem that they have like crazy devoted fans, right? Is that the kind of customers you think you have?
Yeah, they do. But the worries were that a lot of them were not going to stick around once the gyms reopened and things happened. But now maybe the gyms aren't going to reopen.
And Omicron.
Right. So yeah, if you can get it a lot cheaper with any of these, I'm the value investor. So I like to look around and see what kind of deals there were, which is what I did with Pinterest on the original coronavirus sell-off. I liked the company when all that was going on. And so we did find an opportunity to get in there real cheap on the panic selling. So some of these names, people might, the market's going to overshoot wrongly probably on some of these to the downside.
For your value screen, is price to earnings multiple the primary metric?
On some of the screens, yes. But I run alternative ones now that look for some other factors, like even price to sales. I do like to look for price to sales. And then I also just look for those that are values within their sector or industry now, because that's happened quite a bit over time where something like a Facebook, starts to trade down near 20 times earnings, or now with a PEG of almost 1. That a PEG of 1 is a value PEG. So I do go beyond the normal classic value, as we like to call them, with just like the PE ratios and all of that to look for value within a sector.
Yeah. And scrolling down here, by the way, a lot of the figures I'm giving your audience here are right off of the Zacks.com detailed estimates page, where I can get a summary of revenue growth, revenue estimates and projected growth and EPS estimates. Now, the problem with Peloton is that they were climbing towards profitability last year, where they lost 64 cents, but then they gave it all back this fiscal year. They're losing $2.75 for over a 330% downside reversal. And next year,
some of that isn't that because the treadmill issues and all of that.
Oh yeah, I don't even know that much about it. But analysts for fiscal year ending June of 23, so we're still in fiscal 22 that ends in June. Next year, they're still not projected to be profitable. So that's as investors are looking at, the sales growth is nice, but are these guys ever going to make money?
Right. I do look at that. I know some people don't. But you do want to see improvement. I have bought some companies that didn't have earnings even in the value investor if I knew it was going in the right direction. In fact, when we bought Pinterest originally, it was negative, but it looked like it could go positive. And then with the pandemic, it did, because they gained all those subscribers and a lot in the advertising area during the pandemic. But I also knew from listening to those conference calls that they did have a track record to getting there, that they were getting close to getting there, and that they were likely to achieve it. So I was okay buying it. But some others, yeah, I'm a little bit more iffy on, depending. Exact Sciences, they're not earnings positive yet, I don't think.
Since you brought up Exact Sciences, I wanted to mention the bloodbath for ARK Invest funds.
Yeah.
So this is a dynamic that is, it's not causing the meltdown in biotech or software, but it is sort of exacerbating it as investors, question, did Cathie Wood's funds run up these stocks too high? And so now we're swinging, the pendulum's swinging back the other way. So if we just want to talk about healthcare, we can focus on ARKG, ARKG, which is the Genomics Revolution ETF.
Yeah.
All-time highs of 115, now making, more one-year lows today, almost at below 63. So, and they're big buyers of Exact Sciences. I mean, they're buying, they love Exact Sciences, and they love Invitae and the CRISPR stocks, and they actually own them. Like ARK will go out and buy Exact Sciences for its flagship innovation fund, ARK-K, and on the same day they'll buy more for ARK-G. So they're just, and I don't. Cathie Wood's never going to give up with her approach as long as she has enough money coming in, because their time horizon is 5 to 10 years, which most investors can't think that way.
No, they're thinking 6 months.
And for anybody who doesn't know, Exact Sciences is Cologuard. That's their claim to fame. It's the home cancer test.
Of which I saw that they were coming out with Cologuard 2.0, which will be, it's supposed to be a better test than the original Cologuard. So that'll be a mover for the stock, but nobody likes it right now.
Right.
Except Cathie. Okay, so that's some good advice in there, because I do think people are freaking out a little bit, the newer investors especially, because this is the first kind of big pullback in a lot of these growth names than we've seen since the original coronavirus sell-off, like more than 18 months
except
ago.
Nvidia and Tesla. They just keep going.
I looked at Nvidia, and 1 month it's up 26% still. Yeah. So price to sales 35 times. But I'm kind of keeping Nvidia as and even Tesla as two of my markers. If they pull back even like 5%, then maybe we're at the bottom there. If those two pull back, but so far, not much is happening.
It may be Shopify too.
Yes, correct. Those three.
I'm sort of eyeing MetaZuck here, Meta Platforms.
Yeah.
If I get another shot at this, like 320, 315, I might nibble there, because I think that investors just still love it, and that with their scale and their reach, that if they innovate something right, it's gonna keep driving earnings.
Yeah, agreed. Okay, so we had a lot of stock tickers on this episode, so I'll just run through some of them. We talked about LULU and RH. They're both going to report earnings soon, and they're pretty pricey. And we'll see if they get more of a pullback in this growth stock sell-off. LULU is LULU, RH is RH, and I do own both of those in my own personal portfolio. We talked about Microsoft, we mentioned them, MSFT, Pinterest, PINS, Exact Sciences, EXAS, Shopify, SHOP, DraftKings, DKNG, Square, SQ, Salesforce, CRM, the New Relic with does the software analytics, was NEWR. Metaverse is sticking with the Facebook FB ticker for now until 2022, apparently. Big Commerce, BIGC, the little Shopify. The software ETFs, IGV is the cap weighted and EXSW is the equal weighted. Those, if you're interested in those, is that it? Oh, PayPal, we didn't forget them, PYPL, and Peloton, PTON, we mentioned them. I think that's everybody. It's close to it.
Yeah, and throw in ARCG.
Oh, yes, ARCG.
ARCG is sort of a barometer for what's going on with biotech right now.
Right. And I didn't mention NVIDIA. I kept them off. NVDA and Tesla, TSLA. We know those, but I'll mention them anyways. So that's quite a list, a good watch list if you're looking at getting into some growth names and starting to watch them. So with the earnings season coming up, or some of these about to report earnings, tune into those conference calls because they're always eye-opening, especially now with these new variants out there and just, the inflation issue, a lot of things going on. So the conference calls are really interesting right now. So anybody can tune in. All you have to do is, click the link on their investor relations pages and it'll take you right to that conference call. Even if you can't listen live, you can always listen to it on recording, like just shortly after it ends, in fact, these days. So be sure to tune in. And as always, I'm going to be bringing you as many stocks and ideas as we head into the end of the year, end of 2021. I got some good guests coming up, so you don't want to miss a single episode of The Market Edge. You can get us on Amazon Music. You can get us on Spotify. You can get us on Apple Podcasts, of course, and on SoundCloud. But be sure to get us somewhere, and I'll see you again next week with some more stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.